I mean, the number one thing correlated with the prices going up is job growth and population growth. It's actually not supply, believe it or not. So that's been my biggest insight.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you are enjoying this show, do me one quick favor, leave us that rating and review. We want to hear what you love about the show and anything we can do to make you work harder for your investing goals. And if you haven't done so already, or if this is your first time listening, be sure to hit that subscribe button so you don't miss an episode. We've got a great show today. We're going to be talking to Drew Breneman. The real estate landscape is changing, and you need to be prepared to take advantage of the emerging opportunities. That's why you should join me and other top real estate investors for the Midwest Real Estate Networking Summit, May 6th and 7th in Chicago. Now, you want to build the connections and partnerships that will help you scale your portfolio. Guest speakers include Jay Papasan, author of the #1 best-selling book, The One Thing; Ray Higdon, network marketing expert and author of Freakishly Effective Leadership for Network Marketers; and Tarl Yarber, Bigger Pockets contributor and the CEO of Fixated Real Estate. Now, join us for the Midwest Real Estate Networking Summit on May 6th and 7th in Chicago. Tickets are available right now at MidwestRESummit.com. Use promo code PODCAST to save on your ticket today. Again, go to MidwestRESummit.com and use promo code PODCAST to save on your ticket. Drew Breneman founded Breneman Capital, formerly Rise Invest, and co-founded the Blackhawk Investment Group in 2008, and Dwelle, a Chicago-focused real estate investment and property management group, in 2019. Now, he has honed his ability to foresee trends and identify favorable opportunities, resulting in great returns when you consider the relative risk. His foresight is precisely why Breneman Capital has tailored its investment approach to be specific to multifamily investments. Let's welcome to the show, Drew Breneman.
All right, awesome. Thanks for having me, John. Appreciate it.
Absolutely. Hey, listen, Drew, I've known you for some years now, and it's been amazing for me to watch your growth and the trajectory that you're on. But for those folks who don't know you or aren't familiar with your background, take 2 minutes and fill in some of the gaps there.
Yeah, no, appreciate it. Yeah, and we kind of go back, actually know each other from the real world. So good to see you again. But yeah, I mean, really just kind of, I'm still 37 years old now, but got started in real estate almost when I was in high school. So I started an internet business where I was always real entrepreneurial, and I had a friend of mine who was selling items in this video game, Diablo 2 at the time, and sounded like a good way to potentially make money. He had sold all his stuff for like $10 or $20 when he was done playing the game, and I went on eBay, and the things always sold for like really prices all over the place. So I decided, why don't I buy something for $10 and see what I see them selling on Buy It Nows for 20 or 25. So I bought that item and resold it for more, and then just basically did that like thousands of times more, and started accumulating money when I was in high school and wanted to figure out what to do with it, to invest. And I read all the books people probably read when they're normally like my age now, Rich Dad, Poor Dad, Intelligent Investor. I did a book report on Think and Grow Rich, I think my junior or senior year, just to kind of kill two birds with one stone. But I just really liked real estate, where I tried trading stocks when I was in high school, but this was before smartphones. And so you'd try to put a trade on and you'd go to school and see what happened. So it wasn't like a very good strategy. Then you come home from school and it's like, oh, you bought it at the market open and then you lost money. And, if you're 17, then it's like, well, I might as well sell it tomorrow. But I really liked real estate, where I know all your listeners really, for the most part, already know what's great about it, how there's cash flow and you get the appreciation from the property, you get tax breaks, you pay your loan down over time. It's not correlated with other investments. So I was kind of reading through all this and decided, all right, I'm going to get going in real estate when I go to college. And I'm from the Milwaukee area. I went to UW-Madison for college. And when I was a freshman, I bought my first duplex there. I bought 4 properties total when I was in college, 2 duplexes and 2 3-units, and just kind of been off and going ever since. So,
man, listen, you got an incredible story, man. We haven't even gotten out of college yet. So this is great to hear where you started, man. Very entrepreneurial at an early age. You started talking about, the Diablo 2 games and, buying the equipment and selling it there, and then trying to, try your hand at different books, getting into stocks, realizing not really the best investment options for a high school kid, and then realizing real estate is where you wanted to focus. Where did this entrepreneurial spirit come from? I mean, were you like this as a little kid or something with your
Yeah.
parents? I mean, where did this start?
Yeah, both my parents are teachers, so they weren't entrepreneurs. My dad's dad was, where he started a couple nightclubs in northern Wisconsin, and I never met him because he had passed away before I was born, but they kind of said I was like him, but there wasn't really any entrepreneurs in my family. But I was always like this. Even when I was, I don't know, like 7 years old, I was trying to sell stuff to my sister who was younger, like, to like a 4 or 5 year old. And yeah, I was just always like it. And I mean, I had done other businesses prior to the Diablo thing, but I just figured it's already going back far enough. But I was a magician before that, doing kids parties, and I started a vending machine route. Also, just while I was doing real estate, just to make some more money. But then that wasn't making much money compared to what the real estate made. So
Yeah, man, I think that's really great too for those who are, maybe have children and, want to inspire them to put their money to work and become entrepreneurs, or at least to learn how money works a little bit more. There's some great insights on some of the things you were able to do. And maybe there's some things we could do to push our own kids to help spark that love for investing and create kind of the future that they're looking for. Let's get back into real estate though. So, in high school, you're getting these duplexes, they're making you money. At what point do you realize this is the thing that I really want to lock in and on focus on to build kind of my career?
yeah, really, it was I'd say my freshman year, let's say, of college, where I was enrolling for classes, and I was thinking about so prior to going to college, but like, so the couple months before, when you sign up for classes, and I still was thinking about being like, trying to do like pre-med or be a doctor, because back then, kind of my plan, like the Subway restaurant franchises were exploding, and that seemed like, at the time, like that could be a really good avenue, like be a doctor, invest your money in these like Subways, or like roll out some sort of franchise type business. But I'm looking at all these classes and thinking I got to go to school for 12 more years, and I'm literally like already making money, and now I'm investing my money like this, and I would have been, what, 18 years old then, so going to school for 12 years seemed like forever, and it kind of is. And so really, since age 19, so bought that first deal, and then I started taking all the, let's say, like pre-business classes or whatever it be called, and ended up switching my major, or I guess I never officially declared one, like, until I was already changed my mind to do real estate. So then UW-Madison, where I lucked out in a way where I went to that school just because it's the best one in Wisconsin, where I'm from, but they also have the best real estate program in the entire country there for undergraduate. It depends on the year, I guess, for rankings. Either Wharton or Madison gets it. But so I was like, this seems like too good to be true almost. Like, I like real estate. They got the best program. Let's just roll with it.
Yeah, man. So you take that, and then after you leave school, do you jump into a job in the industry? Do you just launch your own business? How does that start to transition?
Yeah, so I had bought those 4 deals in school, and I graduated in 2007. And you could, like, in December of 2007, and you could really see, like, okay, there's a big like a huge recession coming, like there's going to be problems. And I had already invested all of my personal capital into these 4 deals. The thought with them was they were longer term holds, where I wasn't flipping anything. They were all deals that were cash flow positive, and I was buying. Really, when I got started, I didn't know that much. I had read a few books, but I thought, like, okay, just make sure that they're cash flow positive. Then if I overpay, because I'm using the gross rent multiplier to value these things, if I overpay, then at least I can I'll just hold them and wait it out, and I'll still make money if I'm cash flow positive every month. I just might have overpaid. So I had that was sort of my initial strategy, so it wasn't too, let's say, complicated. And then I had done that, and I'm graduating, and I'm thinking, okay, I already invested my money. What should I do? And there's a recession coming. So I figured, all right, I should try to get a job, and really more for the education than, let's say, what they pay. So I picked my early jobs based on what I thought I could learn, really. And I mean, within reason, where they still paid well enough, but it wasn't like I was just gonna like switch job to job for only money, let's say, early on. But so the first job I took was an internship with an office developer in Madison. Then I took a full-time job with a multifamily developer in the Twin Cities up in Minnesota. And then later moved down to Illinois and worked for a retail developer. Um, and so that was from about 2009 to 2012. And then during that time, I really was working though, always kind of on my own stuff. Like everybody knew that was the case, where I was still continuing to invest my own money. And then also in 2009, or actually it'd be late 2008, one of my coworkers, I had explained the same thing I'm kind of doing now. Like I bought these deals. This is what I'm doing on my own. And he said, why don't we go talk to my dad? He's been wanting to invest in real estate. And maybe we could like all buy something together. So I don't like to waste any time. I go and I'm like, all right, let's go meet with them tomorrow for lunch. And so we go, I print out these deals, I bring them to lunch, and they really like what we're talking about. And we go, and one of the deals I printed out of that meeting, we ended up actually buying. So a shopping center, and I didn't have any clue what kind of money they could invest. So I printed out deals that were 200,000 on up to 5 million. And the shopping center they liked was a $3 million deal. We ended up getting it for eventually for like 2.65 million, I believe, 2.6 and a quarter. And I was surprised that they would like be able to invest that kind of money, where this is again with parents as teachers, like they could maybe have sold like all of their everything they had and like thrown in a down payment like that. But then, for someone who you just met, it's like, yeah, this makes sense. Let's do it. And we went, and we didn't waste any time overthinking it. I kind of took the same approach, back then as what I'd recommend people would be doing now, where it's 2008, 2009. Like it wasn't a time to be like owning deals for a year or flipping. Like things were looking like they could potentially get worse. So you want to set yourself up like on the longer term holds. And that's what we were doing, where the first deal we bought, it was 2 7-year leases. One was with Verizon Wireless. So, a multi-billion-dollar company. And we were looking at going, we'll buy 2015 or 16. Like we're definitely out of this recession when these leases roll. And it makes a lot of sense. It's like back then we were buying at like a 7 or 8 caps and borrowing at 5.5. So it was, pretty good. It was like a 15% cash on cash, like out of the gate. So
man, Drew, let me jump in here, because I think you gave so many great insights in your story. And, your story is your story, but I think the thing that is so compelling is just the lessons that we can learn along your way. First of all, you were prepared, man. You had intentionality. While you didn't know what your major was, you knew you wanted to make money. You knew you liked kind of this passive income that you were getting from real estate, even from your high school days and going into your freshman year in college. And then ultimately that led you into studying real estate, at Madison, and kind of going into that field. You said something that really jumped out to me. You said in the early days, you were picking jobs based on what you had learned. And that's one of the principles that really jumps out in Rich Dad Poor Dad. It's not just about money, but it's about that education and learning. And you chose jobs that did that. You talked about working for, a company that focused on office, another company that focused on multifamily, and a third that focused on retail. So you intentionally went out there and learned these different asset classes while getting paid, while building up your own portfolio on the side. So by the time you got to the point where you had this friend who was interested, him and his dad were interested in investing, you could take action and say, excellent. Hey, let's talk about a deal. Let's not waste time. Let me put something in front of you tomorrow. And you had these 3 deals printed out and were able to get them to invest. Now, at that time, outside of your job, did you have any other commercial real estate experience or any retail experience, or was this really kind of the first commercial deal you were doing with them?
No, that was the first one. I had only bought multifamily to that point, and at that point, I worked at a multifamily company, and so yeah, I did learn some at the internship in school. But yeah, there was a lot of learning on the fly. But like one thing that I would say that like I'm really big on from like a mindset standpoint is, like I see a lot of these people where like I look at them and I don't really think like, let's say someone who's buying like a kind of deal or like maybe like a couple levels up, like they have anything like different than I don't. Like they just are different than I do, excuse me. Like they're just sort of, everyone's like I think how to say this, where everyone's obviously different, but like they're not so like so exceptional. Like I could never buy the shopping center or get there. And I do see people that I work with is maybe they're like at another company or like a service provider we'd use for property management or whatever. And I talked to them about what they think they could do, and they kind of have like some like beliefs that are holding them back. And so where I didn't have that. Like I think, like even the people that I worked for, like they had built these really big successful companies, and I'd look at them and I would just thought it was sort of they just took the risks and put in the work. It wasn't really anything else. Like they developed an expertise too as well, I guess, but they it wasn't, none of those people were like, their story was something where they went to like, they have like 3 degrees from Harvard and they then got going with their trust fund. It was none of that. It was everyone just literally started with like a single property, and now they're like 60. So then you see like at the end of all the success, but so no, I just knew I could do it.
What
So
that first conversation, right? I mean, it sounds like this was your first investor, right? So the first partnership, first time you work with someone, first, retail commercial deal. You seemed confident, right, to be able to sit down the next day and you got them to decide to invest with you. Talk me through that, right? Because I get, not being scared, but also it's almost like being youthful. It's like a youthful ignorance, right? Of not knowing what you don't know. But just walk us through that, because I think your point is spot on. There's so many people who are in the industry, whether you are a broker, maybe you're a property manager, maybe you're an investor yourself, and you can find deals or opportunities, and people who have money to invest, but there's something that's holding you back from presenting these deals or opportunities to those individuals to partner up and go take them down. And I'm just curious, what do you think it was for you that allowed you to either overcome that doubt or self-fear, or just to, quite frankly, ignore it completely and just run and just do it?
Yeah, I mean, I really just I guess I just if I just thought I could do it. And I think too, like some of this like the way I guess one thing they may have liked and something else I'm big on is the way I would have answered questions where, I think a lot of people, maybe especially when they're young, they would you ask the question, okay, how does this work? I would never like make up an answer. Like I would say like, I'll just answer truthfully. Like, I don't know, but I can just ask our attorney and then they'll tell us, or I can ask the lender what they would want to do or how that would work. So I'm really big on asking questions and getting to the right people. I know when you were on my podcast, you had my favorite moment of that was when you were talking about you need to be resourceful, and like that's spot on. Like you do need to. Where I had never bought a commercial deal before, but I had just started working at a place where that's all they do. And we got all these old guys working here that I can just go ask a question if I needed to. And then, or I can call my attorney or the lender or somebody, I can get the answer. And so you had said that on my podcast, and that's spot on. And that's what I was doing where, I hadn't closed a deal like that before, but I was surrounded by people that had, and relied on them if I had a question. And I was never afraid to ask the question. That was kind of what I was getting at there.
Do you think that experience made your friend and his dad really comfortable working with you, since you were already in the commercial real estate industry?
Yeah, because that's the other thing where I see people where they want to let's say start doing deals on their own, but they haven't done anything yet. And so like they might work at a place, but they haven't bought any properties. And it's just kind of like an idea. So when I went and met them, I was probably only 22 at the time, but oddly enough, so I would have been his like boss because he was an intern. So then I have like a little bit of more experience. It's literally like a year, but it was something. And then also I was already doing something. I brought deals there. I had deals. I told them about the 4 deals I had bought, what I'm doing at work. So there was a lot of activity there. So it seems like, and it was a big leap for him to invest with 2 young people, obviously for the father, which I definitely don't lose sight of and appreciate, like that he did that. But also there was just a lot of activity there. So like when I oftentimes like I'll talk to somebody who they're working a job, they're thinking of quitting, they want to know like, how do I get from working this W-2 to like doing my own deals? And like I always say the same thing, and it's the ideal scenario is you can start doing deals on your own while you're still working, whether it's passive or active investing. For me, it was active. Like in 2011, I quit that final job. And by then I had owned 5 deals with this family, with a 6th under contract, and I still own 2 deals in Madison. So what is that? 7 properties I had with the 8th on the way. And all of them were cash flow positive. I was making money on each one. And then I quit, where I was already making probably more from that portfolio, or I was, than my job, especially if you include like how much those were going up and paying the loans down. So then, like that's how I always recommend to do it. So, if anyone's out there kind of in the similar situation, like that's, what I'd always recommend.
Yeah, Drew, I love it, man. And what's crazy for me, and it may be different for our listeners right now, is I've known you and your story for some years now, but I didn't really understand the intricate details of like, how you got, hooked up with your friend and his father. And I think initially when, we kind of first met each other, my first thought was like, okay, well, he's got a friend, he's got a rich friend, and they're financing a lot of his deals, and maybe that's why he's doing it. I'm out here trying to, get every $50,000 investor, one by one, right? And you're able to do this, $2.65 million deal out of the gate. But I think one, that was the wrong way to look at it, and two, there's a lot of clues in here, and if you're listening to this and you're thinking, well, Drew, kind of got lucky. He had this friend, he had this guy. There was nothing you said that was about luck. You were taking action. You were committed, you were confident, and opportunity presented itself and you took advantage of that opportunity. You created your fortune, right? And that's something that a lot of people miss. You may have opportunities every single day, but you refuse to shoot your shot. Maybe people who want to invest, but you don't talk to them about investing. You don't share what you're doing in real estate. You don't share what you want to do in real estate. There are people who are probably looking to partner with someone like you, but you have to have that conversation. And in short of or before that, you have to be prepared. And that means doing the work yesterday, today, to get there. You had already had, those 4 properties. You were already working for different real estate companies. You were focused and committed. I think anyone could have seen that. And even though you were only 22 years old, you had accomplished a lot and you were very clear in your vision and your focus. And that's one of the things I think, that guy probably looked at and said, hey, it's young guys, but look where they're at, look what they've done, look at their trajectory. I'm going to take a leap of faith with them because I see how hard he's working. I see what the hustle is, and I believe in that. So I think we also have to make sure that, I call them the 3 C's of attracting capital, right? It's confidence, it's credibility, and it's connections. And you have access to all 3. The confidence comes from the work and being prepared. The credibility is going to be whatever experiences you have or the experiences of the team that you're able to assemble. And then the connections, you've got a lot of connections around you. Now, you might have to get some introductions. And in this case, you were talking to the guy you worked with, and he said, hey, I think my dad might be interested. It's not like he had the money right away for himself, but he thought his dad might be interested. So you have to build on those connections, and you're able to do all 3 of those things to see success. So let's fast forward a little bit, right? So you got Nighthawk. What do you do with Nighthawk? I mean, what did that portfolio look like? And then talk to me
It's
about the
actually
transition.
Blackhawk. Just to sorry
Blackhawk, Jesus, sorry.
to
My bad. I
to
got
do
Michael
that to
Blanc on
you.
the mind. So sorry about
Yeah, I know. I
that.
heard that. I was like, because who hasn't
Blackhawk.
heard it? Nighthawk?
Yeah,
Yeah,
Blackhawk, of course.
but just to reset, I do agree with you on what you're saying, because what's interesting when you're saying that, like, right, this coworker of mine, there were like 20 other deal guys that worked there, but none of them had deals, and none of this never came up. And then, I mean, how many people would have been in his real estate class? Like 100, and but I just kept telling my story. I've told this thing thousands of times. And then, a couple of the times that I've landed a huge, investor. And so you're right. Like, you got to be putting in the work, getting the knowledge, and then, shooting your shot. So for
Yeah,
sure.
man. I love it. I love it. So talk about Blackhawk. Sorry about that. Talk about the
Yeah.
transition. Like, where'd you net with Blackhawk? I think you said about 5 or 6 deals or so, but talk to us about Blackhawk. And then where's the transition into kind of this larger scale commercial real estate firm?
Yeah. So really, so Blackhawk, so we were buying those commercial deals from 2009 to 2011. And then we were trying to buy multifamily, let's say, the whole time, but there weren't any like distressed opportunities. Really almost not much multifamily sold at all during that time in the Twin Cities. So we did these commercial deals where they were heavily discounted, even though they were fully occupied properties, because we were buying from these developers where they might have had 10 screwed up projects and then one full one, and we would just buy the full one with fresh capital. And so then in 2000, for that last job, I moved from Minnesota to Illinois. And so when I quit that, I really wanted to move into Chicago. I was going there every weekend basically for fun, and it seemed like a great place to invest and very exciting. And so that's what we did. So then from 2013 to 2019, we were buying, we really only bought multifamily then in Chicago. We did sell a couple of those Minnesota deals, and then we did 1031s into other commercial properties up there, or into apartments in Chicago. But then from 2013 to 2019, we were focused on multifamily deals that had enough loss to lease, so rents below market, where we could acquire it or renovate it if it needed it, and then raise the rents and the net operating income enough where we could refinance out all of our equity. So we did that on, I did it on 13 deals total. A couple of those were just were my own. So I think 10 of those were with Blackhawk. And on average, we refied out over 100% of the money on each one. So we took this $3 million that the father was investing with us and recycled a deal. 3 million, you would say you buy 10 with that, or 12 million. Then you refi it out, you buy another 10 or 12, you keep going. So we bought 30 million of property in total, returned the capital on the final couple deals, and then we couldn't find any deals like to put that money back into at the time. And so then just went back up to the father then. So, and he did what he did with it. So, and then really so then let's say in 2021, I think is what you're getting at, how we got going maybe. And also we started investing in Phoenix, and now we're getting into Texas. And really what happened in that time, like we did those multifamily deals, the deals went really well. From finding them, closing them, like an execution standpoint, but the market was doing us like no favors really at the time. So you'd buy a deal, and then from there your rents weren't really growing much, and barely keeping up with expenses, and in some deals not even keeping up with them. And so we have, like, all the deals went well. I think our average realized return is a 25% IRR, and so same thing with our unrealized deals. It's like a similar return. So we have great returns, but one thing that's like kind of crazy is at the same time, you could have just bought probably any deal in like Florida or Texas and done, or Arizona, and done just as well or better. And so then, during COVID and the year after, I started looking at like really more like what do the numbers actually say? And so like, let's say Phoenix, from 2013 to 2019, this stood out because I tried to find a time period where we didn't get this like COVID bump, and also there's no recession. Multifamily appreciated 14.4% a year, and the rents grew 7.3% a year in the same time period. And so like that really that jumped out, where this isn't just like a temporary thing. Like, okay, it's 2020 and people are moving to the Sun Belt. This actually had been going on for a long time, and I just wasn't really paying attention to it. I'm just looking for that next, 6 or 8 or 20 unit to buy in whatever neighborhood of Chicago. So I kind of took a step back and thought, what should I really be investing in? I've been doing this at that point for like 15 years. What should the next 15 years and beyond like look like? And I really like multifamily, that I kind of realized along the way, where that has it's just sort of the best in a lot of aspects, where it has the best debt availability out of all the product types. The lease term being a year is great in times of inflation, where you can reset your rents, but it's not like hotels where you got to re-rent it every day. It's really inexpensive to turn over the units when tenants move out. We also went back and calculated at the same time. Once I got the data, and then also had someone working for me who could actually calculate this, but we got the NCREIF data from 1990 to 2020, so it was at 30 years, and we measured all possible return scenarios, 3, 5, 7, 10-year holding periods, and multifamily had the highest returns out of every scenario, and the lowest standard deviation or variance in the returns out of all the main product types. So this is multifamily compared to office, retail, and industrial, beating all of them. And I kind of felt that when I was doing these commercial deals, where the cash flow was very high when you had it full, but then a tenant leaves and your value drops and you have to add money to re-rent it. So it was really like lumpy. So it was nice, I guess, having like, if you have a really wealthy single investor, like it's fine because then we didn't need it, but we always had kind of like almost like a backstop of sorts. Like if we need to add a ton of money that we don't have on a commercial deal, maybe they could. But I didn't really like for my other deals, if you're going to bring in a lot of investors or for yourself to have to go through life almost thinking like, wow, if this industrial deal with 2 tenants or one, if they leave, it's losing money and I need to add money. I like how multifamily is more stable, but then also did have the highest returns. So I like the diversification from all the different tenants. I mean, like a lot of the deals we look at now, there's like 100 tenants in the building, all making money different ways, different employers. And so I really like the diversification. And then last couple things, like all the trends are in its favor where, I mean, current renters are renting longer with how expensive home ownership is, and regardless of where interest rates are, like buying a home is expensive, and for a lot of these people that would be in like a $1,200 a month kind of rental, $1,500 that you'd find in Texas or Arizona or Florida. There's buying a house is just becoming more and more out of reach, and so that unfortunately keeps them in the properties longer. But then it's a total tailwind as the multifamily owner. So I kind of started jumping all around there, but so I sort of realized all this doing these deals, and then figured, why don't I actually make a pivot for once? And then at the end of 2021, we bought our first deal in Phoenix, and have since bought 5 in total. So happy to take it wherever you want from there.
Yeah, I mean, let me recap a little bit of that, right? So you are buying properties in Chicago, move from Twin Cities to Chicago, focusing on, apartment buildings on the north side of the city. Realized that you wanted to broaden this out, weren't finding deals, weren't seeing the rent growth there, started doing some research, realized Arizona, Phoenix in particular was a great market for investing, and also that you should really continue to double down on multifamily. And that kind of really sparked that transition. You've now done 5 deals in the Phoenix market since 2021. And I think the piece for me that is one, you said a term that I don't think a lot of people know. You said NCREIF. Can you just quickly explain what that is, and I'll go back to my next point?
Yeah, what it stands for, I don't know off the top of my head, but it's a index that's supposed to be the most representative thing of private real estate. So, because if let's say you look at a REIT index, those are public companies, and those are pretty correlated with the stock market, where if interest rates go up, for example, hedge funds or whatever high frequency traders, they might be selling short or selling puts on REITs because it's a stock, where this is supposed to be an index that's most representative of private real estate.
All right. Appreciate you sharing that. We'll put a link to that in the show notes. So if you want to check that website out and get some of that information, you can see that there. But as you scale and you move out west, you talked about some of the research that you went through. Can you talk about kind of your future outlook? Because we know, every market's not made the same, and certainly you don't want to be changing markets every single year. So talk to us high level about what your approach is going to be and the kind of things you're looking for in markets.
I mean, really, you got to think about your portfolio composition. Let's say if you're going to be in more than one market, if you want to just invest where you live, like that's a great strategy. Because also, I guess for starters, like I think you can find good deals in any market. There's good deals in bad real estate markets still, whether we're talking about like from the cyclical nature of real estate, or you live in a city that's not as favorable. Like I lived in Chicago, and on most ratings, it's like Baltimore, Detroit, Chicago are like near the bottom, but we were still making 25% IRRs and doing full cash out refis. So like you can still do well by where you live. So if you're hearing this and you go, okay, sounds nice to be investing all over the South, but I live in Nebraska or something, or Detroit, like you could just do it there and, self-manage your properties and be, super hands-on, close to the real estate. There's nothing wrong with that. But for what we're doing, like we're trying to build a portfolio, and so have an offering for passive investors and some institutional investors that where we try to think like what cities kind of pair well together. So Phoenix is a really great high growth city, but does have volatility. And it's not really tied to one industry, let's say, where you think about like the Bay Area, like of course that's tied to tech, and also like Austin, Texas, and Raleigh would be other tech cities, for example. But so like Phoenix, like so we like that because I think the number one thing that's correlated with appreciation was population growth or job growth. Those were the top two as a percentage. So it didn't have much to do with supply, let's say, of apartments, or it was really more just on the growth. And Phoenix is always, whatever you look at, near the top or at the top for growth. And they also have the most favorable property tax laws in the country, where they have this thing called Rule A, where they don't change your assessed value by more than 5% in a given year. And they do not, by more than a 5% increase, and they do not change your assessment if there's a sale on the property. And so all these other places I had bought property, they all chase your sale. Is a term for it. If it was assessed at 5 million and you pay 10, they'll raise you to 10, or 9.5, and or pretty close. And so in Phoenix, you have so much, and I think it's all of Arizona, but we're just looking in the Phoenix MSA. So much certainty with the growth is there, and the property taxes, what you're getting. Insurance is low because they don't have any natural disasters. So that's been a great city for us. But it does have like a history of volatility. If you think back to 2008 with the whole housing bust, and that's so what we were looking for, let's say, in the next market was something that's growing but more stable. And so we found that in Dallas. So the markets we're looking at now are Phoenix, Dallas, Austin, Texas, Nashville, and Charlotte. But really those first three are where we're looking the hardest now. And so though all those next four I mentioned, they're much more stable. So I think if you were to match up Phoenix with the other more volatile markets, so like Las Vegas or Atlanta or most of Florida, like then now you're just all risk on. There's no like, where's your stable markets? And you're kind of seeing this with the rental rates already and how cap rates have moved, where the rents in Phoenix have dropped, and as well as in Austin, Texas, they've dropped. But then Dallas, they really haven't, and neither in Nashville or Charlotte, because that whole Carolinas and Tennessee area is in Texas. That's in terms of the growth parts of the country there, and then the mountain region, let's say Salt Lake and Denver, are the most stable. So we were looking for like stable with growth. And I guess why we didn't pick the mountain states is just those are already kind of expensive. And so one thing we found looking at the data was the just in terms of the chunk rent, so the rent just in dollars for an apartment, the higher it gets, it's a headwind for rent growth. It has a lower correlation with rent growth. So just the fact that Denver is whatever 2,000 something for a one bed, where in Nashville it's 1,000 something, without any more info, like Nashville would do better. Obviously there's a million other factors, but those are pretty comparable markets, so it makes sense to compare that way. You couldn't really compare, let's say, Milwaukee with Denver, because there's too many different dynamics there. But anyway, so then that's why we started looking at Dallas, and Austin was really for the stability in the growth, where you have huge population and job growth there with all these relocations. And then, so Dallas, we like it for the stability. Like I mentioned, that's turned into basically like a core market now, where, these institutional investors, they all wanted New York and LA and San Francisco, maybe Boston or Washington, D.C. And now like Dallas has made it in the mix, kind of in that sort of conversation, where less of San Francisco or some of these other places and more Dallas. So you have an institutional quality market, where some of these other ones, I don't know if they would, where if you're like an insurance company investing money from China or something, like they do a lot of deals in Chicago, in these big cities, where our biggest high-rise was being built by a Chinese insurance company till they got out of it. But like that's the kind of stuff you would see in Dallas, but you don't really see in these in like a smaller city, let's say like Charlotte. So we wanted something more stable. That's why we started mixing in those. And then I think too, like you'd have more confidence buying when things are kind of unknown and unstable like they are now, where we're kind of on the where things are pulling back price wise and rent wise, where you'd have more confidence stepping into a more stable market. So that's why we started adding those.
Yeah, Drew, appreciate that feedback on how you started selecting the different markets to grow into and what your criteria was. I think it's very helpful when you think about balancing the portfolio. You have some markets where, there's high growth, but also a little bit of volatility. So pairing those with markets where there's more stability in those markets and maybe not as much growth, but they're going to be more stable. So as an overall portfolio, you have a well-balanced approach to find these investments. For folks who want to learn more, they can check out your podcast, The Breneman Blueprint. That's a great podcast that I had the pleasure of being on as well. So the Breneman Blueprint, excuse me, and we'll make sure we link to that in the show notes. And if they want to learn more about investing with your team, they can go to breneman.com for Breneman Capital. So we'll make sure we put that in the show notes. Right now, we're going to go to our round of insights. Are you ready?
All right, let's go.
All right, give me a failure or an apparent failure that sets you up for later success.
Oh, interesting. The I don't that's a tough one. Really what I guess one thing we didn't talk about, and I didn't want to get the whole thing sidetracked, actually the in this father-son relationship with Blackhawk, actually the son passed away in 2019, where he so like that as well, like kind of like forced me, let's say, to do some of this where that sort of got me reevaluating in part. I was already thinking this, but then there wasn't anything with maybe we should be investing outside of the Midwest, but I didn't have a jolt to do that, and unfortunately that was the jolt. So as sad as it is. So
yeah, sorry to hear that, but
Right.
Obviously I know you have to move on as well. Give me a digital or mobile resource you recommend for your business.
Yeah, I mean, it's if you're an active investor and you can afford it, like there's so much great. Everyone knows about CoStar, but I would say the RealPage and Yardi have really great data for multifamily owners. And then if you're just more like an individual investor, I think just if you've already heard of Bigger Pockets, but there's a reason for that. Like they have everything you could basically never leave the Bigger Pockets ecosystem, and you could learn everything you need to know to get going. So
Give me the book you've recommended or gifted the most in the last year.
yeah, the Real Estate Investing by Gary Eldred is the book I always give out for people getting started in real estate. That's the one I probably bought the most for people, is that one. And that's sort of the one I was reading where the light bulb went off in high school there.
What's a daily habit that helps you stay focused on your goals?
I mean, really, like I try to have one thing in mind that I'll do. I have a 5-year-old and a bunch of employees and properties to worry about and investors, and so I get a lot thrown at me every day. But I try to be like, at least I'm going to get this one thing done today, and then try to get that done first. Because if you don't kind of get going on it right away, I never seem to get to it. So I guess that's the habit.
Give me your number one insight for multifamily investing.
I mean, the number one thing correlated with the prices going up is job growth and population growth. It's actually not supply, believe it or not. So that's been my biggest insight.
All right. Well, listen, you're in Chicago. You got to give me your favorite place to grab a bite to eat.
Well, I really love sushi, and whether I'm in Chicago or anywhere, if they have a Nobu, that's my favorite place. But if you're coming here and you want something different, like Girl and the Goat here in the West Loop where I live, that's been more or less the best the best restaurant for like 15 years for good reason. So I mean, I'd hit that up if you're in Chicago and can get a reservation.
Great choice there. Listen, Drew, it's great catching up with you, man. You gave some great insights on one, just getting started at an early age, having that passion, trying to figure out how do you feed that fire. And ultimately for you, it was real estate investing, starting with those duplexes in college, then transitioning into the corporate world, where you're working in commercial real estate firms, and then ultimately building this partnership where you were buying these larger properties, commercial properties, and then scaling that into what you have today with Breneman Capital. So just really great insights, and I think some great lessons learned about overcoming, self-doubt and fear, and just taking action, believing in yourself, believing in your preparation, but also just being resourceful. There's always going to be something you don't know. Be resourceful, have the people in your team that can help you figure it out, and that's going to help you see success. If you want to learn more about Drew, check out his podcast, The Breneman Blueprint. You can also check out his website, breneman.com, BRENEMAN.com for Breneman Capital. Drew, just want to thank you again for taking the time to be a guest here on Multifamily Insights. We look forward to staying in touch, and I'll talk to you again soon.
All right. Thanks, John. Appreciate it.